Hello everyone and welcome back to another summer school class. I am Sam North, the trading school lead at eToro, and today we are focusing on what type of investor are you? So far we have talked about why people should invest, how they can know whether they can afford to, and also when is a good time to start. This sets us up really nicely for this video. For those who are new to investing, it is quite unlikely you will know right now what type of investor you are. So we will go through some questions to help us better answer it. Firstly, it can be useful to ask yourself how much time a day or week can you give to your investing journey. For some people that may be plenty of time, whereas for others it might be very limited to work commitments, for example. The more time someone has, the more potential they have to be an active investor. On the flip side, for someone who can't dedicate that much time to investing, then their focus is more likely to be long-term and they will hold positions for a longer period. This isn't a bad thing though, as we do want to have patience when it comes to investing. But for that person who is dedicating a few hours a day, they may be able to take advantage of the shorter term changes in market conditions. Now I know what you might be thinking. For someone who is in and out of positions or investments often, could be considered a trader. And to an extent, yes. The main difference between trading and investing is the timeline for holding positions. Investing takes a longer term approach, while trading focuses on shorter term strategies. So if someone had more time, they could be both a long-term investor and a short-term investor/trader. They might be invested in certain markets for a few years, but take advantage of a change in company's share price following a good earnings report, for example. The next question to ask yourself is, what are your short, medium, and long-term goals? What are you looking to achieve? Are you looking to make a full-time transition to be a full-time investor? Or are you looking to build wealth over time? Again, for someone who is looking to do this full-time, they may hold investments for slightly shorter positions on average, as they have the time to take advantage of the volatility. Whereas someone looking to save for retirement is going to have a longer term approach. It is important to set goals and understand what exactly you are looking to do. Also, how active do you want to be? Do you want to be doing this all the time, or is this something you want to do alongside your work? For someone who trades or invests more frequently, in theory, there is more opportunity to generate returns, which of course is a positive. However, this does work both ways, let's remember. For someone who gets into more trades or investments, there is a risk they will lose more. Short-term investing requires more skill than long-term, as we have mentioned before. Generally, markets over the long term do go up, but trying to time the market perfectly is very tricky. Another question to ask is, what level of risk am I happy to take? You've probably heard the saying, the greater the risk, the greater the reward. And it's true. I'm going to make a bit of a generalization in a moment, so please don't take offense. But who do you think is happier to take risk? A young individual who has hardly any bills to pay and no mortgage, or an individual who is nearing retirement? Now, I imagine most of you are on the same page as me when I tell you that the younger person with fewer bills and commitments is happier to take risks than someone who is ready for retirement. Someone in their 50s and 60s isn't going to want to invest in something that in theory could drop 10–20%. They will much prefer a steady investment that maybe doesn't have massive rewards, but it importantly doesn't have big risks either. Whereas the youngsters have time on their side, and investing in something slightly more risky could be very fruitful. And if it doesn't work out, they aren't going to be in trouble, as they have plenty of time to recover. When we look at risk appetite, we can go into more detail and actually focus on the different weightings of assets within someone's portfolio. Before we do that, let's discuss what we can consider to be more and less risky. For example, a risky asset could be commodities like oil and gold, stocks, crypto, high yield bonds, and emerging market currencies. Whereas safer assets could be government bonds from countries like the United States and dividend-paying stocks from long-established companies. Remember, no investment is risk-free, but there is a huge spectrum when it comes to how much risk is involved. On the spectrum, we can say high risk is investments that may yield high returns, but also may yield large losses. Moderate risks are investments that generally offer a stable return and capital appreciation in the long term and low risk are investments that have the lowest risks but generate the lowest level of returns. Now let's look at some of the examples of different portfolios based off different risk appetites. Remember, when looking at these examples, the past performance is no guarantee of future results, but Fidelity and Morningstar have gathered some interesting stats and data for us to discuss. For a conservative portfolio, which has a weighting of 50% in bonds and 50% in stocks, the average annual return was 5.93%. For a more balanced portfolio, which was 60% stocks, 40% bonds, the annual return went higher to nearly 8%. For a more aggressive portfolio, where it was 85% stocks, 15% bonds, the average return, that went to 9.77%. So as we can see, on average, the data that they pulled from 1926 to 2021, the more aggressive portfolio averaged higher returns. But let's look at the worst 12-month return for each portfolio. For the most conservative, it was minus 17%. For the balanced one, minus 40%. And for the most aggressive, it was minus 60%. So here's a great example of why someone who is more risk averse will be happier to have less reward to reduce risk. On the flip side, when we focus on the best 12-month return for each portfolio, the results are wide-ranging. For the conservative one, it was 31%. For the balanced one, 76%. And for the most aggressive portfolio, it was 136%. For someone who is younger or just in general happier to take risk, the risk reward will make sense for them to be more aggressive in their portfolio and investment decisions. Hopefully, by answering the questions we have gone through in this video, you will have a better understanding of what type of investor you are going to be and what level of risk you are happy taking. You can, of course, change your style of investing through your investing journey. And as we have discussed, those earlier on may be happy to take more risk to potentially generate more and bigger returns. Whereas those closer to retirement are just focusing on maintaining their investment account with as little risk as possible. Next up for us is, what should your investment goals be? Now, you'll have to excuse me, I'm going for a dip. See you next time.